Welcome to the Insightful Investor Podcast, a weekly series that seeks to share industry, investment, and market insights. We define insights as concepts that are counterintuitive, widely misunderstood, or underappreciated. In other words, unique ideas that you probably won't hear elsewhere. I'm Alex Shahidi, the host of the podcast and co-CIO of Evoke Advisors, a leading investment advisory firm. Learn more about our show at insightfulinvestor.org. Today's guest is Mark Sear. Mark is co-founder and managing partner at Evoke Advisors and one of my partners. Since 1993, Mark has advised wealthy families and institutional investors, beginning his career at Goldman Sachs before joining Merrill Lynch 5 years later, where we first met in 2002, over 20 years ago. In 2008, he and his partners founded Luminous Capital, which was acquired by First Republic Bank in 2012. In 2019, Mark co-founded Evoke Advisors, and our two firms merged in 2020. Welcome, Mark.
Hi, Alex. Thanks for having me.
Let's kick it off with your background. I've known you for a couple decades, and I know you're very passionate about investing. What do you think originally sparked this passion?
I think, one, I'm super curious, and I'm very competitive. And I think if you're that unique combination, investing is great because it allows you to spend as much time as you have looking for things that maybe other people missed, or maybe there's situations where people thought about things differently and the paradigm changes. So I've always just been very intrigued by that. And then I'm really competitive and I like to get into the fight every day and see if I can come up with strategies that maybe help make me more money or my clients more money. And so investing never ends. If you think about it, you're always looking for something interesting to talk about or interesting to explore. And so I think if you're curious and competitive, it's a great field.
The curiosity spans the world, and it's one of those environments in which you can never really master the craft. You can always get better, but you never get to the end. So that combination, I could see why it would be attractive.
And I like history too. And I think history is an interesting, people always say it rhymes, but it's different or whatever. And I think that you've got to always be curious and looking for things that maybe people missed.
I know you're also very passionate about doing what's best for the client. As we know, and we talked about a lot, most everyone in our industry says that, but their actions may suggest otherwise. What ignited that fire inside of you?
Yeah, it's funny you say that. When I started my career, the first two firms that I worked for had the client's interests come first. Frankly, I didn't see that as I started my career. And I think that what makes it difficult is clients always don't know what's going on behind the scenes. They don't know where in our industry it's full of hidden fees. It's full of different kinds of investments that maybe aren't articulated or shown to the client properly. So I've always been on this sort of crusade to try to put the client's interests not just ahead of mine, but try to make sure they're understanding really what they want to accomplish and trying to deliver that for them. And I just don't think the industry is as good as I'd like it to be in that. So for example, I don't think clients or investors get reported to properly. I don't think they are helped to know how they're doing. I don't think they're helped to know what they're paying. I don't think they're really educated on their performance of what they've invested and how that was relative to other choices. So I've made it my career's work. I had to learn for a while about what all this was. When I started my career, I didn't even know any better. But I've been doing this 30 plus years now, and I really certainly have dedicated the last third of my career to going out of my way to make sure that not just myself, but my team and my firm really makes an effort to have people understand what they're investing in, understand the risks that are inherent in every decision, understand what they're paying, understand what other options are available that might be more economic, understand how taxes are important and a very big cost in what they're doing. And so, yeah, the client's interests are super important. Everybody says that's the case. But with me, I think we're really trying to talk the talk and walk the walk. And so I'm very proud of what we've done in that area.
I think a lot of it has to do with putting yourself in the client's shoes and viewing the world through their eyes, which is easier said than done because you live the world through your shoes in your eyes. And you have to almost remove yourself from the common situation in which you find yourself and place yourself in the world that they see you and almost forget everything you know and wonder what types of questions should they be asking? What do they need to know? And looking at it from their perspective.
Yeah, there's many things when you become passionate about something, an expert at something, you spend the lion's share of your life or your career at something, you know it very well and you understand it very deeply. It's hard to do that, Alex. It's hard to think then, okay, what would they be thinking? What would they be asking? What are their concerns? Because I do this every day. And I feel like it's just things that are like normal course of business aren't for other people. So you do have to do that. It's hard to do that.
I know you're also an avid golfer, and we've talked about this before, but you found some very interesting parallels between golf and investing. Well, what are some of those?
Well, first of all, I mentioned earlier competitiveness. So you have to compete at golf, and it's a competitive sport. And I think investing is that way too.
What's interesting about that is in golf, you're competing against others and yourself.
Yeah, which is a segue. If you think about it, I don't know of another sport where people who play the sport call infractions on themselves. So you think about if you watch a basketball game or football, you have to have a ref and everybody argues. In fact, now you have to watch it on TV to see, oh, is that guy really inbounds? That doesn't happen in golf. People literally in golf say, my ball moved or I touched the ball erroneously and I've got to penalize myself. And so in investing, it's sort of the same way. Ethical behavior is super important and doing the right thing is super important in investing, especially when you're investing client money. And so I think there's parallel high ethical standing that is parallel in both instances. I think anybody who knows me in the golf world, I'm a practice junkie. I practice when I have time to do that, but I really love to practice. I almost love to practice more than I have to play. And then you think about investing, the practice, the effort, the energy you put into the golf is similar to investing. It's hard to be an effective investor unless you've done the homework, unless you understand the industry, the company, the uniqueness of it, or if you're looking at different asset classes, really understanding what affects them. And so I think another similarity between golf and investing is just the time you have to put in to be good at both is a lot. It's a big commitment.
To master the fundamentals.
To master the fundamentals, yeah. And there are fundamentals, obviously, to golf, and there are fundamentals to investing. And if you don't invest in those when you start, you're not effective at anything else down the road. It's very hard to be good at golf if you don't understand how to grip the club. Same thing with investing.
I imagine patience is also an important attribute.
Yeah, it's hard in both if you think about it. How many times have you made an investment and you're really thinking you're right, you've done your homework, and then it goes against you? And it's very difficult to have the confidence and to stay the course and to be patient and wait through the normal course of time that will make the investment turn out to be a good one. And with golf, it's very easy to get distracted while you're playing or to get frustrated while you're playing. And I think if you've done your homework and you've got a good game plan and you stick with it, just like with investing, there's many, many parallels. The more we talk about it, the more I'm realizing, yes, you have to stay the course when it's hard to stay the course. And investing and with golf, it's remarkable how many similarities are. No wonder I love both things so much.
And also emotions play a material role.
You can't allow emotions to spoil a round of golf, and you can't allow your emotions to get in the way of investing. I think it's interesting. There's a coach, my brother also played college golf. I played college golf. And the coach used to say, don't look at what you don't want to have happen when you're playing. Look at where you want the ball to go and focus on what you want to have happen, not what you don't want to have happen. If you think about investing, you can get wrapped up in all the fears and the things that could go wrong with the investment. But I think like with golf, you've got to do your homework and then believe in what you're doing and look where you want to go.
I imagine on the golf course, sometimes the ball doesn't go straight. And so you have to adjust and be adaptable to the circumstances, just like in investing.
And think about too, weather, course conditions. There's many things in golf that come up. And in investing, you think you're on the right path, you're doing great. And then the Fed raises or lowers interest rates that you didn't expect. It just came out of nowhere. Or there's a recession indicator that gets suddenly the market's changing tune. You have to be able to adjust because those will affect your investing world. You have to be able to make sure you're nimble and thoughtful about how to deal with all that.
Well, you've been a financial advisor for over 30 years. What do you think are the best parts of your job and what aspects do you find the most challenging?
For me, I'm a lover of the human condition. Like I like people. I like trying to understand people. The things I like to do the most is to develop deep relationships with folk. If you think about it, in my industry, you can have lots and lots of clients and know them at a very shallow level. Or in my world, we tend to have wealthier families we work with. You have a smaller number of clients and you get to know them very deeply. And that's a great fit for me. So what I love about the job is spending time with my families, getting to know what they want to accomplish. I love it when they give me a problem. That's my favorite thing. Here's what's bothering me at these 3 or 4 things. I wish I could do this. I wish I could figure out how to solve this puzzle. I like to solve puzzles. Give me the data. Let me see if I can work with it. Without question, the fun part about the jobs are the puzzles where your clients can't solve something. They trust that you're capable and they give you the opportunity to take a crack at it, and then you get your head into it and you hopefully can come up with some good solutions. So that's my favorite part. The things I don't love about the job have more to do with, I think, the industry than the job itself. The industry, again, I mentioned this earlier, I think it could do a better job of being more transparent, being more honest, less salesy. I hate the whole sales aspect to the industry. We at my firm, I know, Alex, you spend more time than anybody here making sure we're investors first and not salespeople. And I think that that's one of the things that bugs me about the industry, that so much of the DNA is built on how strong an argument you can make, not what's best for the client.
Well, you've had a remarkable career so far. You began your career at Goldman Sachs. How do you think that experience shaped your early perspective on the industry?
Well, I feel like I'm the luckiest person in the world to have gotten an opportunity to work for Goldman Sachs in the early 90s. I don't think they're doing the training program the way they did it, but think about this. I started Goldman Sachs. They sent me to New York for a year. I'm in New York for a year, and I'm learning from the smartest minds in the business, and I'm doing a cycle through all kinds of different fixed income trading. I'm getting to watch people trade, non-US bonds in different currencies. I'm working with the research department. I'm working with the trading desk. I'm getting to do all kinds of really interesting assignments. And through it, I'm getting trained on how to be a better advisor. Many people who know me have said that was the luckiest thing that ever happened to me, that I ended up there spending a year with arguably the best firm on Wall Street at the time, doing that and getting a level of understanding of the markets and how they work. How does trading really work? How do these things function on Wall Street? And so I'm very, very blessed that that was part of my beginning of the job.
So you moved from Goldman to Merrill Lynch. What inspired you and your team to make that transition? And what were some of the key lessons that you learned at your time there?
A couple of interesting things. First of all, let's be clear, super difficult decision for me. I had at the time been on a team with 3 other individuals, and I'm a team-focused, family-focused person that if you make a commitment to this group, you got to stick with the group. At the same time, I felt so lucky to be working for Goldman Sachs. Who in their right mind would leave Goldman Sachs? You're crazy. So for the first time in my life, I had this very, very difficult decision at a relatively young age. I was in my early 30s. And I had this sudden realization that I either had to leave the firm I loved or leave the team I loved. And that was really hard. It was my first in my life. It still sits as one of my 5 hardest decisions I've ever made, without question. And it was really tough for me. So the lessons I learned were things changed. And I'd think about, why were we considering doing this? And the reality was, at the time, Goldman was focused on the Goldman brand, and they were selling mostly in-house, if not entirely in-house products. So if you wanted to invest in Latin America, you had the Goldman Sachs Latin America Fund. And if you wanted to do this or that, you had the Goldman Sachs this. And they weren't the best at everything. And we had migrated, my team and I, to this place where we wanted to provide our clients with the best resources, not the house brand. And so we took a leap of faith that clients would leave a great organization like Goldman because the model wasn't as good as we wanted it to be. We felt like there could be a better model, a better mousetrap. So we left and went to Merrill Lynch, where we felt like now we could offer our clients any fund, any investment service or product, not just the branded product. You got to go back to 92, 93, I started my career. So this is like 1997, 1998. Back then, the house brands, that's how everybody did. You'd go to a firm for that firm's products. And then there wasn't really this idea that the advisor picked the products. The firm still picked the products. And we were, I think, thoughtful. I think one thing about my career that I'm proud of is I think we were always looking 1 or 2 steps ahead of what was coming. And it was clear to me that just because I was a client of X firm, I shouldn't be completely subject to only their advice and only their recommendations and only their solutions, and that there were better solutions out there or other solutions out there. So that was the reason for moving, even though it was brutally difficult.
I think part of the way to think about it is, my sense is you saw yourself as working for the client as opposed to working for the firm.
Yeah.
And if you view it through the client's eyes, then the decision becomes a little bit easier.
And it was reinforced when we talked to clients about moving with us. I thought I can't leave a certain firm that I love. And the end of the day is when we told them why, and we said, look, if I was the client, I'd want a broader array of choices. I wouldn't want to be relegated to only one choice. And they understood that. And essentially all the clients came with us. So I felt nervous going into it and vindicated 6 months later.
And now when you look back 27, 28 years later, and you see where the industry is today versus where it was back then, it seems like that was the right move, considering that you were right in your estimation of how the industry would evolve.
The idea that the client goes to an organization for the organization doesn't exist anymore. The client goes to what's best for the client. And if there's somebody that can provide them great advice, and that advice is broader and it can be more, I guess, larger, and that they have more choices, the client benefits. You take a really hard look at this. Where's the client better off? Somewhere they can get everything, including Goldman Sachs' products, or just at Goldman Sachs? That's an easy one to answer. So if you look at it backwards, like you said earlier, you got to think of it from the client's perspective. They really care about the brand name on the door. What they want is the broadest product offering and the smartest team and the best service. And so we made the move. It turned out to be one of the scariest things I've ever done, but also probably one of the best things that turned out for me. Because if you think about my career after that, it all was predicated on that first move.
Yeah. And then there was another scary move, potentially, where you shifted from working at a brokerage firm to launching an RIA and then ultimately moving to First Republic. Would you talk about that evolution?
This one probably was easier, only in that when I left Goldman, it was, first of all, fewer people were ever doing that. You worked at Goldman Sachs, you would never want to leave there. It was the best place to be, or at least that's what people thought. The reality, it wasn't the best place to be. There was a solution for my clients that was superior to where they were. As we continue on that continuum, what are we trying to give clients? More choice, better pricing, more competition among different options to put into a portfolio.
Transparency.
If you keep that continuum going, then you're like, why am I in an industry that is governed by FINRA under the suitability legal standing? Why wouldn't I want to be a fiduciary for my clients? Why wouldn't I be governed by the SEC and be a fiduciary and suddenly get on the same side of the table? It's a longer conversation, but the brokerage business was really built up out of this idea that you're selling something. Think about it. You're an agent for a broker-dealer. That's your legal standing when you work for a broker-dealer. So my clients, I'm their agent, and I'm representing an organization. That's the channel. And suddenly it was clear to me that that's not the right channel. The right channel is to become a fiduciary for your client and be able to do anything the client needs. And so when we saw that, leaving the broker-dealer business and starting a new business as a registered investment advisory firm seemed at the time much easier than going from a wonderful organization as a broker-dealer to a different firm, going to Merrill Lynch inside the same industry. It was harder to get my head around that as opposed to leaving an industry completely and starting a business as a registered investment advisor and becoming a fiduciary for my clients. It's exactly what I've always wanted. If I'm service-oriented, if I want to do what's best for the client, I might as well be legally obligated to do that.
In hindsight, it seems very obvious, but at the time, these moves were less obvious.
Yeah. And also, Alex, remember at the time was September 2008. The world was on fire. Actually, we left May of 2008, but we really got up and running a couple months later and it was ugly. And so it was very scary. But think about it. When you work for a firm, they tend to have a message. The firm has a message. When we became independent, we suddenly didn't have a firm's message. We had our message, and that was embedded in sort of what the client's needs were. When the world imploded, having an independent voice was actually novel. I wasn't at these firms that had created CDOs and other type of toxic securities that blew up.
Those firms were having challenges themselves.
Yeah, they're in a lot of trouble. Suddenly, the smartest minds in the world had blown up the system. And so being an independent firm, custodying their assets at Fidelity and Schwab, which weren't involved in that at all, seemed suddenly really smart. Now, don't get me wrong, it was a scary time. The whole system was being questioned. But there was no question that we were getting a lot of meetings from people that for their whole lives only knew of broker-dealers. And my broker at the certain firm, I was with this firm. I'm at Goldman, or I'm at Merrill, or I'm at Morgan Stanley. Suddenly, we're at nowhere. We're at our firm. Then it was Luminous Capital. And we have all this experience and all this intellectual skills, and we can invest in anything we want. Where open architecture was the big word at the time. And suddenly we're getting an opportunity to not have to have an argument that our firm was pushing. We were just serving the clients as best we could. And so I think backwards looking, it was serendipity that 2008 happened when we did this. It wasn't planning. We were going and suddenly the world blew up in our face. It turned out later, however, when you look back, that had things been good, people probably would have been less likely to take a meeting to hear a competing argument. We had a competing argument. I'm your fiduciary advisor. I have access to all the products and offerings. I can give you unbiased advice, non-proprietary advice, And that really resonated partly, well, one, it's a good argument. And two, it was a good time to make that argument. So I got really lucky there.
And Luminous was acquired by First Republic, where you were for some time. And then you eventually decided to return to being a pure RIA by co-founding Evoke Advisors and then merging it with my firm in 2020. Would you talk about that transition?
Sure. So first of all, yes, we went to First Republic Bank. We got a very exciting offer to go to the bank. There was one deficiency in our model. It kind of exists today, not at the same level, which was lending money wasn't something an RIA was really good at. Banks can do it. Broker-dealers can do it. Obviously, First Republic Bank can do it. It was very appealing for us to offer that other opportunity to the client base. So we went and did that for a while.
While maintaining open architecture.
Yeah, and so it seemed like a good fit. So success breeds challenges. And as the firm grew, the uniqueness of the platform that we went there for stopped being available.
In some ways, it was too successful.
Way too successful. We grew like crazy, not just our team, but the whole organization. And things got really different. And 5 years later, it wasn't where we went. And I don't think our clients got the high level of service I would have liked to them have gotten. I don't think that some of the things we wanted to do on the investment side, we were capable of doing at the organization. So we tried to change things at First Republic, and then it's like, it's not going to happen. They were pretty clear it wasn't happening. So David and I are, do you want to give this one more shot? I think we can change the world, and let's go do it. So we did it, and we got off to a great start. And fairly quickly, well, actually, if you remember, during the process, we were talking. And one of the things I used to love is when David and I would go over to your offices and we talk about investing, because you asked about investing earlier. One of the cool things about investing is you don't have a monopoly on all the good ideas. There's a lot of other people that see the world differently, or even people who see the same economic factors or the environment the same way you do, have a different way of articulating it. And so talking to people who are successful and have a deep and thoughtful process to investing has always been great. And we were doing that, as you recall, for a couple of years. Every quarter we'd get together and talk shop, and we love that. And so when you and I and David talked and Damien talked about maybe we're going to leave and having you guys help us do that, you already had office space and stuff that made it. It's very nice to slip into the shoe, if you will. And so we joined, and it was one of those things. I think everybody that listens to this podcast knows there's certain things that happen in life that just happen easily. It turns out that y'all get along, and it turns out that you see the world similarly. And it turns out that my life's goal to better serve the client and to try to change the industry for the better is your life's goal. That's pretty cool. You and I have never had a competing view on anything in that regard. And that David and I drink from the same trough. He thinks the way I think. And then Damien, who's hyper smart and a great investor, but he's also one of the most client-centric persons I know. The four of us coming together got really fun and I think great idea. And then, of course, as you know, we saw it take off. You guys had always focused on a little bit different part of the business than we had. While we had some overlap accounts, it was like a little bit of different focus. So it was great to start introducing my clients to you and Damien to do some of the stuff on the endowments and foundation sides. And I think, as you know, we had some big successes early. So yes, this was one of those things that you do in life. There's never was a point along the continuum that didn't feel great.
And of course, First Republic went out of business.
Yeah,
and that was a few years later. So when you look at that outcome, it certainly was the right move.
I've told people that I just think I'm living a charmed life in some way. The fact that I went to First Republic and said, look, our business model's changed while we've been here. There's things that are now happening that aren't in my client's best interest. I'd like to see if we can resolve them together, and I'll commit to staying here for the rest of my career, and I'll take a lot of my comp in stock. I believe in this mission that much, and it didn't happen. That's not the road they wanted to take. And I left, and it was loss. I didn't want to leave. We wanted to come up with a solution. And yet in defeat, I leave, and it turns out to be a win. Like if I had stayed and taken my comp in stock, it would have been a bad outcome. I'm the kind of personality, I go down with the ship. Yeah, I would have gone down with that ship. So
I'm glad that worked out. So you've worked in both brokerage firms and RIAs. And throughout your career, you've witnessed the evolution of the investment advisory industry over the past 30 plus years. How do you view the industry today, and how would you characterize its changes since you started?
You and I, as you know, run the intern program together. My favorite day is, I think, the first day when I try to give them an overview of the industry and I play the E.F. Hutton ad. And you know, I've played it for you before, which is this whole ad where these people are in a crowded restaurant and the broker who works for E.F. Hutton says, well, I'm with E.F. Hutton, and E.F. Hutton thinks, and then everybody stops talking and listens carefully. Somehow E.F. Hutton has the right answer. And so when I started my career, there was this whole belief set that my broker's smarter than your broker, and I have better ideas with my guy than your guy. And if you really analyzed it, it's just not true. It's just not true. The idea that somehow one person has got all the smart ideas and none of the bad ideas, it's just not true. And it's really more of a sales organization. So the industry started in the stock brokerage world, and people got commissions for doing activity. So the more ideas you came up with, the more successful you were. If you can convince people you had all the good ideas and none of the bad ideas, you get lots of clients, and then you can convince those clients to do things. Instead of not doing things, you got more commissions. And so that was the business that I entered into in the early 90s. And then really two things happened. One is some bad actors started trading too much, and this whole concept of churning came around, and this whole thing of unauthorized discretion, which was bad, and that needed to be curtailed. Married the same time that the brokerage business was very cyclical. When times are good, I buy a stock at 20 and it goes to 4, it's easy to get you to sell it. When I buy it at 20, it goes to 10, it's very hard to make you sell it. So it's a very cyclical industry. And the idea suddenly came up that we could do away with the churning stuff and we could smooth out earnings for these corporations if we just charged a fee for advice. And so the brokerage business went away from the transactional business and it migrated over to a fee-based environment, which had some benefits, but I believe over time it's also had some costs, which we can talk about another time. But the point is that that's where it started. But while the pricing model changed, the sales DNA didn't change. These big firms that have these big research departments are coming out with ideas. That's how they market themselves. And so for the 90s and the 2000s, that was the prevailing way the business worked. And then all of a sudden the RIA world pops up and these start to get populated with the most successful brokerage people. They're leaving because they understand the model's better on the other side of the fence when I'm a fiduciary. And as people migrate over, you now have this RIA business, which is less salesy in my opinion, because
it's
less
competitor.
products. No one's creating products in the back room and getting you to sell them. And so the industry is changing for the better, in my opinion. But a lot of the firms, a lot of the bulge bracket firms still are run by the people that 20 years ago were salespeople. The DNA and the culture of these large firms is still sales oriented. What is the sales plan? What products do we have coming out? What should we having research focused energy on so we can get more great ideas? And less to do with great advice. And one of the things that has been really apparent to me, and I'm glad to see my firms doing great things about it, is the idea that in the investment piece is only a cog, one part of the leg of the stool, if you will. That great advice is also tax planning. Great advice is also estate planning. Great is also the ability to do estate planning for people. It's also a myriad of other things that do with financial modeling and helping people do things that make their lives either easier, better, or safer. And that's where the puck's going. So the industry has changed a lot. I still feel like there is an undercurrent of salesmanship in the industry, and I wish we could get further away from that. But we're making good progress, and I think firms like ours and many others will, I think, lead the way to what I believe is a better way to help clients.
So it sounds like, in general, it's improving in terms of what's best for the client. Is your feeling that it's going too slow, or are you satisfied with the speed of the improvements?
I don't have numbers to back up my argument, but I guess I would tell you if I could do this, and I probably could get on ChatGPT and figure it out later, but if you look at total assets that resided inside the brokerage firms in 90, and then in 2000, and then in 2010 and 2020, you have to take out market appreciation, a sense of, because the market's gone up a lot over that period of time. But I don't think enough assets have migrated over to the RA side to make me feel like the sales argument. I still hear too many people, oh, my guy had this great idea. He got me into NVIDIA. Oh my gosh, I'm making all this money. And in my sense, that's not what it's about. Because yes, there's one NVIDIA for every 2 or 3 things that went down a lot. And then you've got tax friction, a lot of fees. And so I think there's an academic argument that can be made to create well-balanced portfolios that withstand the test of time, low fee, low tax. I'm not suggesting for a minute it's not fun to invest. We started, the first question is, why do you love to invest? I love to invest. But that should be sort of the backbone of your portfolio. And then if you on your own, the client wants to make a bet on something, go for it. I love that. I do it myself. But at the same time, there are other investments that are out there that are very high returning, very interesting, that don't need the stock market to do well. So I think that the changes happen. It's probably not fast enough for me. I don't know how long a career lasts. I've been at it 30 years. I'd like to see it get better in my career, and I'm running out of, I got maybe 10 years left.
If you were to build the ideal wealth management firm from the ground up, what key features and priorities would define its structure and client experience?
Let me think through the structure first. I think you need a really robust investment platform, and you need to have alternative investments around that. I just think that the more tools you have in the toolbox for creating a return stream that withstands whatever happens in the world. We're in the wealth management business here. We're protecting wealth. And in order to do that, you need a very strong research effort and an investment effort. So I don't want to poo-poo that. You need that. I think then you need to be able to, we're a big fan of doing people's taxes. We think that that's a way to integrate. Because think about it. If we have an investment in this firm, it's in 100 portfolios. We know it on the tax side. People doing taxes here know that way better than anybody that would know it outside. You may have a good tax guy away, but he's going to see it one time. We're going to see it 100 times. So understanding these alternative investments that can be tricky, better to have an integrated serve, in my opinion. So that's an area, another big area. Being able to do effective tax planning is very important. I think you need to have an estate planning arm. Even a trust company would be helpful. But I think that's a very important piece of the perfect model. And then I think there's ancillary things. I think the team that helps you has to be good at modeling and thinking financially. For example, how do I make decisions? We had a question the other day. Somebody's like, I want to help my 3 kids buy homes. How is the best way to do that? And there are different ways to do that. So understanding it, modeling it financially, helping the client make that decision, I think is very important. So the perfect firm will be able to do all those things. And then the client experience, I think it needs to be much more where we're getting an understanding of what they want to accomplish, and we give them great information on how they're doing relative to the other choices they could have made. A lot of people don't realize today the risk-free rate's 4%. You can go buy a 30-day T-bill and get 4%. You don't pay state income tax on it. So it's like, I get that for free. So really all we're fighting for is how much better I do than 4. And when people need to understand, when you show up with your performance results, what you're really paying for is the benefit you gave them, not the number. And I don't think that gets talked about enough in our industry. And so we want to help people really understand what they're getting and what they're paying for it. And that has to be part of the experience at the perfect firm.
For a long time, that 4 was 0.
Yeah. And so that made life a lot easier because you were competing against nothing and it made returns higher. But that's not the case. Historically speaking, that's rare. And I would imagine you're a better historian than I am, but I bet you that number looks closer to 5 over 100 years than 0.
We've talked about client centricity. What does genuine client centricity mean in practice? And importantly, how should clients recognize it?
A client-centric firm will put the client at the front. And then once you understand their needs, have a large amount of different solutions for them that come out of what the client needs, not what you're trying to sell to them. You meet somebody, they're saying, hey, like your firm, I want to come work with you. I think you can help me. Think about when you go to the doctor. Hey, I've got these challenges, doc. What do you think I should do? That's client-centric. If I picked up a person on the street and said, hey, you don't look like you're walking very well. I got these 2 great things that make you walk better. That's the way the industry's built. And so client-centric is when you meet somebody, you really get a deep understanding of what they're trying to accomplish. You have a bunch of tools to deliver it, but you don't have a dog in the race. You don't care which one they choose. You want to have them get an honest understanding of how they work and how they fit into their overall portfolio, how they fit in from tax standpoint, how they fit in from estate planning standpoint, how they fit in from a risk standpoint. Maybe they have leverage in it. There's a lot of things. Look at a couple of iterations and help them pick the right way to go, as opposed to always selling them an idea and something. If you think about the things that have gone wrong in our industry, credit default swaps and the CDO problem and all that stuff that came out, it was always somebody was selling something, and it doesn't tend to end well.
Reflecting on your decades of experience, how has your philosophy toward advising clients evolved, and what shifts in mindset or approach have shaped your practice over time?
A lot. When I started my career, I was picking stocks and picking bonds. Now think about me. I wanted to play professional golf. That didn't work out. So I was in a food company for a year. Then I do get the benefit of going to business school and going to work for Goldman Sachs for a year. And somehow I'm picking stocks and bonds. Now, to give Goldman credit, they were off a recommended list. It wasn't just whimsically picking things, but that's how the model was. So I started with that model. And then over time, I went from picking stocks and bonds to picking funds. So I went from smartly, let's not pick a stock or a couple of stocks, let's pick a fund that has lots of stuff in it, much safer. But I'm still getting my advice from the mothership. Shift to the right, buy more stocks, buy more bonds, do this. And there was this pricing challenge that risky assets, you get to charge more than low risk assets. So there was always this, what we used to call risk creep, that you'd always be pushing a riskier idea because you got paid more. And so that's where I started my career. And it's migrated to where today I still love to invest. And if somebody's got a good stock idea or I've figured something out in my mind, I'd love to learn about it and read about it. I'm really learning as much as I can about artificial intelligence now. AI is really interesting and it's going to be, I think, obviously impactful in so many ways. So I love that pursuit. But in terms of investing, it's changed completely today. Now we're using ETFs. They're low cost. They're low tax. They're a much better way to go forward. I have not heard it. I mean, I hear the extremists say, well, because of ETFs, the market's going to crash or something. I don't know why an ETF helps the market crash anything more than a mutual fund does. No one's explained that to me yet. But at the end of the day, the ability to do good work is much better today. We couldn't diversify like we used to, even 5 or 6 years ago. The ability to construct great portfolios for people today that participate in all parts of the economic cycle and give people reasonable returns with relatively low risk, that is so much easier to do today than it was when I started my career. So yeah, the investment process has changed, the tools have changed, and it's shocking to think how my thinking has evolved. I started my career trained by Goldman to go out and sell ideas. And now I'm much more interested in creating diversified, balanced portfolios without having an argument. I do believe the markets are efficient, and the best way to game the system is to create a relatively low volatility portfolio that captures the risk premium in the market as efficiently as possible from a tax and an economic standpoint. And then if I want to go and invest in an alternative fund because I really want to take advantage of energy, I really want to take advantage of the secondaries market, or I want to be in apartment buildings. Like there's great ways to do that have high returns. But my core of what I do is very efficient, very relatively low risk, very low fee, very low tax. And that's how you build wealth over time.
It goes back to the core principles of investing. It's very simple. Invest. You benefit from compounding. Diversify so that you don't happen to be in the wrong thing at the wrong time. And be patient. And if you think about it, those rules existed 100 years ago. They still exist today.
They'll exist 100 years from now.
And they're hard to do, which is fascinating. If you think about this craft that we're every day trying to master, you boil it down to its simplest elements. Those 3 items that I just described, those are very simple to understand. They're very compelling. They prove true over time, but they're really hard to do. Isn't that fascinating?
One of the things they did teach me at Goldman was to always do the hard things first. And if you think about it, the hardest thing to do sometimes is to do what you know is right. It gets so hard to not get swept up into the Mag 7 race right now. It's so hard not to do it, but you know that if you just are disciplined, back to your earlier questions about like golf and things like that, just stay disciplined and you are patient and you construct a well-diversified portfolio, over time you will come out, the tortoise wins the race.
That's right. So we've talked about what it was like to be a financial advisor 30 years ago. We've talked a little bit about what an exceptional advisor might look like today. What does an exceptional advisor look like 10 years from now?
Well, obviously AI is going to change everything, in my opinion, because throughout recorded history, intelligence and knowledge tend to push you ahead. So if you had more intelligence and you had more knowledge, you tended to do better than people on aggregate that didn't have as much intelligence and knowledge. And our system is built that way. Is AI going to make intelligence and knowledge free? I don't know. But when you think about it of investing, it is my belief that over time, a lot of what we do every day can be done using artificial intelligence to have it done better. So I think the thing that can't improve or that AI can't make a big dent in it is the connection between the client and the advisor. Let me put it this way. If I went back 30 years ago and said, I've got an unbelievably high IQ person with no EQ, do you want him? I'm like, absolutely, I want that person. But I think the model for the future in 10 years, you're going to need these individuals that are super high in emotional quotient, the people that can really ask the questions, engender trust, glean out the really bits of data that are helpful in helping people make decisions. Because the modeling piece that's been important for so many years and the research piece that's been important for so many years, those are getting marginalized every day. Yet people still need great advice. People are going to want to go. And I liken this career path I've taken a lot to the medical world because there's so much I don't know when I go in to see the doctor. Just like when somebody comes into my office and says, I need your help investing my money, there's a lot they don't know. And artificial intelligence is going to help people know more in either facet, but I still need the connection with the guy that's my physician. I think people are still going to need that connection with their advisor. And that's not going to go away. I know people say that the younger generation doesn't need that. I know that the internet, the access to the internet, people on their screens all the time, there's a lot of things I've read that say that the humanity of everything we do is being diminished over time. And maybe I'll be wrong on that. But when it comes to your money, having somebody who is tried and true and has good results and has an ability to be patient when you're not, has an ability to have a background of knowledge of history that can say, I know you feel this way, you got to see it through. Those are really important things in getting a successful plan. Helping people not spend so much money, like with the interns. If you build a model that says you're here today and you'll be somewhere in the future, and where it takes you in the future isn't where you want to be because you didn't have enough economic reward, I always say to the class, how do you get there? And the first answer is, we got to make more money. I'm like, well, every dollar you make, the government takes half. That's a lot of work. Why don't you invest better? Then what happens? What if you just invested what you have better? Take your marginal time, don't work, but work on your investments. Well, then you're only keeping 2/3 unless you don't sell it. But the best way to do it is don't spend so much, because then you get dollar for dollar. And so I think having somebody help you with things like thinking through your portfolio on how do we get you, where do you want to be? How do you want to get there? What are the tools? And then artificial intelligence is going to make 10 years from now. It's a long time. I mean, I think I've seen how much things have changed in my career up until now. It'll be very interesting to see what the tools look like and how the markets react to the high levels of intelligence that are available to make decisions.
And with investing, there is art and science. So the science, maybe AI can help you with. The art is more challenging.
That's what we're talking about. I mean, you may say, if we look backwards, science was a lot of important. The art's not so much. Maybe today it's 50-50. In the future, the art's going to be the piece that matters.
Yeah. And then also with dealing with clients, and you're dealing with their money, either individuals or institutions. It's money, and it incites emotion. And you have to be able to manage that process. And a computer is emotionless. I don't know how well it can manage the emotions of an individual with time.
It can't. That's going to be the one thing that changes. You say, how is it going to change? That's going to be the big change. The investment process will be certainly different, but the outcome won't be too different. There'll always be a risk-free rate. There'll always be a risk premium to taking risk. And so I'm not sure how AI is going to change that, but the idea of a connection with another human being and having somebody really feel they can trust you and that you have their best interests at heart and that you know the questions to ask to help them understand themselves, that's where it's all going to be.
And I guess ultimately, an advisor who knows how to use AI to supplement the insight that they have, an advisor plus AI is probably better than just an advisor on its own, and probably better than just AI on its own.
I mean, we're using it all the time to help solve puzzles. It just saves a lot of time. I mean, a lot of work time in terms of if you wanted to get data on things you're looking to make a decision, trying to figure out what's really the market cap or what's all these different things that can help you do it very efficiently, obviously. So yeah, for those thinking about entering this field, this is the decade to do it. Because if you think about what we just talked about today, from E.F. Hutton, when they say something, everything in the investment world was what somebody in New York said about a certain thing. And it's going to migrate all the way over that has no value anymore at all. And yet the industry will go on and there'll be something else that replaces that great idea. And I think it's going to be this ability to help people not only feel good about the connection they have with you, but understand themselves so that they can make more effective decisions. And the truth will be told. One of the other things that's interesting is we keep saying this whole idea of if you're just balanced and stay the course and are patient, that's the most effective way. And limit taxes, limit fees, all those kinds of things, that's the most effective way to invest. I think that's going to become more and more clear as you have a competitor making investments. It's a machine and it's very smart and very fast. And so a lot of these great ideas are going to get weeded out.
Well, it's an industry that doesn't offer as much transparency as it probably should. And it's getting better, but it probably has a long way to go. So I appreciate you taking the time, sharing your journey and the insights that you've learned. I hope our listeners have found it helpful as they navigate through potentially turbulent waters ahead. Thank you, Mark.
My pleasure. Enjoyed it, Alex. Thank you.
Thanks for listening. We hope you enjoyed this episode. Please visit our website at insightfulinvestor.org to access past shows and learn more about our podcast. If you have questions, feel free to email us at info@insightfulinvestor.org. And if you enjoyed the discussion, please subscribe to this podcast to ensure you don't miss future episodes. And don't forget to forward today's conversation to others you think would enjoy listening. This podcast is provided for informational purposes only and should not be relied upon as legal, business, investment, or tax advice. All opinions expressed by podcast participants are solely their own opinions and do not necessarily reflect the opinions of Evoke Advisors, their affiliates, or companies featured. Due to industry regulations, participants on this podcast are instructed not to make specific trade recommendations, nor reference past or potential profits. And listeners are reminded that securities trading, commodity trading, and alternative investments are complex and carry a risk of substantial losses. As such, they are not suitable for all investors. Listeners should be aware that guests featured on The Insightful Investor may have current or past associations with Evoke Advisors or the host, including as an investment manager of a private fund opportunity by Evoke, or access through an affiliated Evoke fund, or as a client. Participation as a guest on the podcast should not be perceived as an endorsement or testimonial with respect to Evoke Advisors, the podcast host, or their services. Similarly, the inclusion of a guest on the podcast does not imply that Evoke Advisors or the host endorses the guest or any company with which they may be affiliated or employed. Evoke has neither paid nor received compensation from guests for their participation.